Ladies and gentlemen, please stop panicking about Bitcoin's price falling. This is nothing that is abnormal. Yes, Bitcoin is down 50+% off of the all-time high from November. It hit $69,000. Nice. Back in November, and it has dropped 50%. But that is not abnormal compared to the historical price drawdowns that we have seen. Yes, this is a volatile asset. And so when we go ahead and we look at all of these historical corrections, what you can see here is all the way to the far left. Back in January of 2012, there was a 42% drawdown. Then we got a 56% drawdown in August of 2012. Then we got an 82% drawdown in 2013. We got a 49% drawdown in 2013 again. In 2016, we got an 86.9% drawdown. Then we got a number of 30 and 40% drawdowns all the way through 2017. Then, of course, the big bad bear market showed up in 2018, 83% drawdown, baby. Then in 2020, 60% down. 50% of that was literally in one day. And of course, in last year of 2021, we had a 51.1% drawdown. So last year alone in 2021, there was a couple of things. We had over 6 different drawdowns of 20%. We had 3 or more drawdowns of 30%, and we had a 50% drawdown. In the last 4 years, there has been 4 separate drawdowns of over 50%. Calm down. Stop panicking. This is par for the course. When you have an asset that goes up hundreds or thousands of percent to the upside, of course, it is going to have corrections along the way. But even if Bitcoin, which is drawn down 50%, was to go down another 50%, which would mean 75% off of the top, it still would not be more than what we saw in 2016, in 2013, or in 2018. Now, I personally don't think that that's what we're going to see, but it is important to keep that perspective. If we go back to last year during the summer, what we saw was there was a 95-day bear market. Not really a bear market, it was a market correction is more likely. That 95-day period, we saw a 51% drawdown in Bitcoin's price. So far, as we have bled off of those all-time highs of 69,000 back in November, we're about 73, 74, 75 days into this current market correction. So if we were simply to repeat last summer, we got about another 20 days. Take a deep breath, go grab a glass of wine, maybe a cigar, and chill the hell out. If we look off of those 2021 highs, it's not just Bitcoin though. There's tons of assets. Terra, Luna, down 49%, Bitcoin 50, Binance, BNB 51, Ethereum 53, Avalanche 64, Solana 66, Cardano 70, XRP 72, Shiba Inu, I told y'all that was a shit coin, down 76%, and Dogecoin, which I also told you was a shit coin, down 84%. Now, of course, when there is a drawdown in Bitcoin's price, everything else follows. Bitcoin is the king. Bitcoin is the blue chip. And so naturally, you should expect this. And then, of course, if we look at the Bitcoin correction, our friend Charlie Bolillo here, absolutely coming in hot with the stats. What you can see is that Bitcoin high of about $69,000 all the way down to about $33,000, 52% decline. In order to return to a new all-time high, it's 109% upside. Let's see when that happens. After the markets have bottomed in the past, it has been everything from 8 days back in 2017 all the way up to 1,181 days to return to a new all-time high. Nobody knows what's going to happen in the future, but what we do know is that this is not the first time it's happened. Again, in the last 4 years, there has now been 4 50% corrections. Chill out. Stop the madness. John, what do you think?
Yeah, I mean, this is nothing new to Bitcoin and cryptocurrencies, right? They are extremely volatile in the market. People are continuously getting liquidated, which is drawing the price down even further. But this is almost what we should be expecting when you look at the looming Fed rate hike, when you look at all other stocks are down. People don't like it because it starts to mean that these cryptos are correlated to the stock market. So when all the stocks and tech stocks are getting drawn down, so is crypto, which isn't really a good sign because it's really looking at crypto as a commodity and not the currency that a lot of people want to view it as. So we just have to watch this coming forward. I expect this to be pretty similar going forward, but hopefully we'll see an uptrend later on this year.
Joe?
Yeah, I think it's interesting how Bitcoin has performed over the last few weeks specifically. What I'm more interested about, though, is like what happens from here. The Fed has everyone is assuming they're going to hike rates multiple times. Some people are saying 2, some people are saying 4, some people are even saying 7. I don't think anyone has any general idea or specific idea, but generally people believe that they're going to hike rates. I think what's interesting though is like, what do they do in the face of this, right? Tech stocks are selling off. Everything is selling off, really. Crypto is down a lot. Bitcoin is down a lot. You got Peloton's down 85%. Netflix went down 25% in one day the other day, right? So like every risk asset is selling off right now because of the expectation that the Fed is going to come in and hike rates. And that's what happens when they hike rates. So ultimately, it's going to be interesting to see like how aggressive do they get? Do they do it at all? I don't know the answer to that. I think people still expect that they're going to do this regardless of kind of short-term pain in the market. But ultimately, that's what's going to start to drive these things, right? Because if you think about inflation, everyone wants inflation under control. 7%, it was a 40-year high. I think, everyone from elected officials to regular everyday citizens want that under control. So the idea is that you raise rates, but ultimately the stock market plays a huge role in that. And if everyone starts seeing their 401k get crushed, their stock portfolio get crushed, the general market get crushed, I think that narrative quickly can change. So it'll be interesting to see kind of how the Fed reacts to this, because just the insinuation that they're going to start aggressively raising rates has obviously had a material impact on the stock market. It'll be interesting to see if that changes their viewpoint one way or the other.
There's a entire thought process that inflation ends up following the conversation. So if people think inflation is coming, they start to move capital based on inflation coming, right? You try to front run the inflation. You start to increase your prices of goods because you think inflation is coming. And so the more people think inflation coming, the more they act that way, the more they act that way, the more that they actually force the inflation to actually show up, right? So conversation or narrative can drive the outcome. I think what the Federal Reserve is trying to do here is the exact same in the opposite direction. Is they're trying to say, hey, the more that we talk about raising rates, the more that we talk about kind of tightening and tapering, then the more people are going to act as if we're doing it. And therefore, that will help drive the impact on the market that we want. And they actually aren't going to end up, in some cases, we've seen public companies or bank CEOs say that they think there's going to be 6 or 7 different interest rate hikes in 2022. I don't think that's going to happen. I do think we will get some interest rate hikes, but I don't think it's going to be anywhere near as severe as kind of the doomsdayers are saying, right? I think what is more likely is that they're actually using the language and their posturing to drive action. That action ends up leading to much more, obviously, sell-offs, etc. But there's absolute carnage in the market right now. But at the end of the day, it's still a good time. And what you have to be as an investor, to Joe's point, if you look backwards, if you try to drive down the street looking in the rearview mirror, it's going to be real hard to stay on the road. If you look forwards, it's much easier, obviously, to stay on the road. And as an investor, that's your whole job, right? Charlie Munger, Warren Buffett, the number one rule in investing is don't be stupid. Basically, just avoid stupidity. And if that is the key, if it's simply just stay on the road, make sure you don't get blown up, don't have high leverage, don't lose all your money, don't unnecessarily interrupt compounding, all these timeless investing principles. Stay on the road. Look through the windshield, not through the rearview mirror. When you look through the rearview mirror backwards, you're making stupid decisions. I dare any. Actually, no, I'm not going to say that. Please don't anyone go try to drive by looking in the rearview mirror as they drive down the street. But you get the point.